Hello, my name is Gonel Leboulet. I'm a senior partner at BCG, and I'm heading our global wholesale banking activity here. Today, I'm with Mark Wiseman. Mark, you had so many roles in global financial institutions. You led CPPIB, the Canadian Pension Plan Investment Board. You chaired Blackrock's investment committee. And nowadays, you're working at Lazard. You're chairing the Alberta Investment Management Committee Corporation, and you're even a senior advisor with us at BCG. Thank you for that. So today, I'd like to start with the climate question. I feel there's so much demand these days for ESG label fund. In 2021, for example, the growth for ESG passive funds was 38%, I believe. Last year, we did a survey with institutional investors, and they said for 2/3 of them that climate was the number one topic in their investment strategy. At the same time, we hear so much worries about the quality of what are the investable products there. So what is your view, Mark, on this? How is the market being shaped?
Well, let's talk about two things, Gwenelle. And first of all, thank you for having me here. It's great to see you again. It's great to be here in person at BCG's offices. But I think there's two phenomena that are important to understand. The first is, where is all of the pressure coming from? And when I think about it, I think about the pressure actually moving through the system for more ESG exposure from stakeholders, be it pensioners, governments, funders or endowers of funds, through to the asset owners who aggregate that capital, who then hire asset managers, who then allocate that company that capital to firms. The pressure is really moving from stakeholders through that system. So if you're, like I am, the chair of the board of a pension fund, or the manager of an endowment, or even the CIO of a family office, you're feeling tremendous pressure from your stakeholders to do something in your investment portfolio to better reflect the values that those stakeholders have, particularly around climate, but also more broadly around ESG. That means that you are then putting pressure on your asset managers, be it Blackrock or KKR or Blackstone or Fidelity or whomever is managing that money, to reflect those values of your stakeholders in the portfolio choices that are being made. So this pressure is unrelenting. I don't believe that it's going to change. And when you see asset managers in particular bringing on board more and more ESG product, they're seeing the market demand. They are seeing the opportunity to gather assets that have that ESG label on them or that sustainability label on them in order to satisfy what their clients, the asset owners, want. So it's logical that you're seeing more and more product coming to market. It's also logical that in that sort of rush to get things on the shelf and to address that market, that you're seeing, like any new market, variability in the quality of the product that's being put there, and then the buyers of that product over time, the asset owners, becoming more sophisticated and ensuring that they care more and more about the quality, not just the label of what they're buying. So this phenomena and understanding where that pressure is coming through the system, I think is very, very important, and it's unrelenting. So that's the first point. The second point is that there's really two views. If you really boil it all down, there's two views that why would you buy as an investor? Why would you buy an ESG product? We can get into the details of what that means, but why would you buy it? Well, there's two reasons. The first is a little bit the phenomena that I was talking about earlier, that you somehow have a need or a desire or stakeholders who want you to have more exposure to those factors or less exposure to bad factors, carbon emission, for example, in your portfolio. Let's call that, for example, a values-based decision. There's also the value-based decision, which says, well, wait a second, as an investor, I actually believe that those products, those financial products, those investments, which have a relatively higher exposure to positive ESG factors, let's say they're lower carbon emitters, for example, will be more valuable, right? It's a view of the market. Now, what's really interesting is that I believe in the long term, those two things converge, and that values and value converge. It's just supply, at some level, it's supply and demand. But investors take two different views. Some of them are today very value driven, and some of them are very values driven in making the decision to move their portfolios to have more, let's call it ESG factor exposure.
Mark, thank you. That was extremely clear. You mentioned offer and demand, and you mentioned the quality of the assets. There is also the volume of the investable assets, which might be the question. So how do you see this volume picking up, and how can we create the real investable assets for this inherent demand for value and values?
Well, this is the problem. It is, as you say, a supply and demand issue, and that creates a bit of a self-fulfilling prophecy. If you look at something like renewable power today, arguably renewable power assets are extremely expensive. So in other words, they have a low yield or a low expected return because there's so much demand for those assets. And does that return necessarily reflect appropriately the risk that one has in owning those assets? Now, why that's interesting is, I think this is sort of a good news story for the world, because if there's more demand for the assets or a lower yield on those assets, it'll allow more of those assets to be produced. But to be clear today, by and large, there's an insufficient amount of, let's call it ESG compliant assets in the world as compared to the number of people and the number of funds that want to acquire those assets. And as a result, you've actually seen a positive return, or actually positive alpha in the last 3 years from ESG factors. Now there's a second issue, and this is a big one for the industry, and I think for all of us to think about, is how do we assure quality? How do we know what we're actually getting is compliant? How do we rate these? How do we appropriately rate these assets? How do we score them? And there's a whole industry that has come up just trying to provide some view of the metrics. We know, for example, financial metrics. We have GAAP or we have IFRS, and we can measure sort of the financial quality with some degree of consistency of what we're buying. For non-financial, or let's call it pre-financial metrics, things that may affect the value of the company in the longer run, but aren't measured by EBITDA margin or revenue recognition, it's a lot murkier. And then the agglomeration of those assets, the quality of the funds or the quality of the product that's out there is also very, very murky. So that's, it's not unlike sort of any new market or any new product, but that's the other big issue out there. How do we know as an investor that what we're buying, be it a product or an individual asset, is actually delivering what it's promised to deliver?
Thank you, Mark. Let's talk about the role of banks there. Corporate and investment banks have a big role to play because they're providing funding to the corporations that do their own climate transition, the new project that they have to fund, the new supply chains, and so on and so forth. At the same time, they can distribute those assets to investors. So I feel they play a big role in the puzzle. Do you feel the same way, or what could they do even more?
I think there's a huge opportunity for banks and financial institutions writ large to intermediate this market. There's a massive measured, as you and I have talked about in the past, measured in the trillions of dollars of capital that's going to be required to finance the transition. And similarly, as we were just talking about, there's trillions of dollars that wants to finance that transition. And in my view, it wants to finance the transition in no small measure because there's an arbitrage to be made. And what do I mean by that? The arbitrage to be made from the investor's point of view is saying, I can buy, let's just take climate as an example, I can buy a heavy carbon emitter. I can apply capital to institute technology or other things to that heavy carbon emitter, and I can turn it ideally into a lower or low carbon emitter. If I can do that, I essentially end up with a multiple arbitrage. I go from a low multiple carbon emitter to a higher multiple company that is doing a better job, let's say, sequestering carbon in its product value chain or whatever it is that it does. So the question is, you've got capital that wants to do it, and you've got firms that have a need for that capital. The role of the financial institution is, as it's been since financial institutions started hundreds of years ago, to intermediate that market. I think today, financial institutions and banks in particular are just at the front end of understanding the opportunity for them to intermediate that market and to help efficiently supply those trillions of dollars to where it's needed to affect the transition. And I think for banks in particular, they need to think about it that way. How do we stand between the providers of capital and the consumers of capital, and how do we make that allocation as efficient as possible for both parties, and as a result, we get paid in between. I think a lot of banks, in the early stages have thought, well, boy, we've got to make a net zero commitment. We've got to keep our stakeholders happy. We've got to make sure that our portfolio reflects what we've said in terms of our own commitments, et cetera, as opposed to viewing it as an opportunity to do what banks have always done, which is to intermediate, highly complex and fragmented capital markets in order to create efficiency. And I think this opportunity is going to be one of the biggest ones probably we've seen in our lifetime.
Thank you, Mark. I'd like to come to another topic, which is inflation. By the way, there is a link between the two topics, which is that structurally, at least I feel, that because of those trillions of capital to be funded, this will drive inflation in the very long term. But nowadays, since the beginning of this year, we've seen unprecedented levels of inflation, not seen in the last 40 years at least, in many of our geographies. What's your view on that? Is it structural? Is it something that we will see for the medium-term future, or is it something that will fade away?
Well, look, I've been saying this for a long time. I didn't understand. Nobody's using the term anymore. This concept of transitory inflation. Inflation is rarely transitory, and I think it is highly structural. And I think part of it is being driven, as you mentioned, by climate transition and the amount of capital that's required, and the contention for goods and services to make that transition to a lower carbon world and a lower carbon economy. But I actually think that's not here yet. I think as you look in the medium and long term, and is this going to persist? I think we need to worry about that. I think in the short term, this is being driven by a whole bunch of factors that are quite hard to reverse. And I think as a result of that, we're going to be in a persistent inflationary environment for a period of time, and central banks in particular are going to be in a very difficult position in how to deal with that. And remember, we really haven't dealt with this problem, as you said, probably since the 1970s. And when we dealt with it in the 1970s, the world was in a very, very different place, right? We just had come off the the dollar peg. We were coming out of the Bretton Woods system. The economy was far less integrated, far less complicated. So we are really in uncharted territory here, and I think we're in a very precarious place from a macroeconomic point of view.
We're talking about the role of financial institutions there. So, both from an investment side and from a banking side, what will be the consequences of a long-term inflation at a level not precedented?
Well, look, if you're a bank or even if you're a pension fund, this isn't necessarily a just looking at it very individualistically, this isn't necessarily a bad outcome. I think it's quite a problematic outcome for the broader economy, and we'll come to that in just a second. But I think let's just take a pension fund, for example. So, and as you know, I've spent most of my career, be it at Ontario Teachers or the Canada Pension Plan, or now in Alberta, involved in managing pension assets in one way or another. And a lot of people, when they think about pensions and the so-called pension problem, particularly here in the United States with underfunding, they think about the asset side of the equation. Right? We don't have enough assets to pay our liabilities. Well, guess what? Actually, higher interest rates and a higher discount rate has a really good effect on your liabilities if you're a pension fund manager, because higher interest rates mean that the net present value of your liabilities are substantially lower, and you're going to see, for example, pensions actually becoming that are underfunded improve their funding status, not because of return on assets, but because of a reduction in their liabilities, unless, of course, they're indexed to inflation, in which case that issue doesn't necessarily exist. For banks, as you know, higher inflation means it's a spread business for the most part, means better outcomes for banks. It means better outcomes for those providing credit to the market or fixed income type products to the market. So it's not bad. In fact, it's probably good for the earnings of financial institutions or for the sustainability of pension systems. So there's a good news story there. The problem is, of course, that comes at a cost, and the cost is to the economy. And what is it going to mean for longer term economic growth, particularly if it's structural, which I tend to believe it is, and I tend to believe it is because so much of this is sort of higher cost supply chains because of decoupling, because of the need for resiliency, and something that people aren't talking enough about, and the acceleration of demographic trends, in no small measure as a result of COVID, which means that we are going to be in a prolonged period of extremely tight labor markets. So all of this, to me, while it might be good for pensions and for some financial institutions, I think for the overall economy, this is a very challenging period of time. So, if you're a bank, okay, good news, higher interest rates. Bad news, our customers aren't necessarily doing so well.
So how to prepare then, maybe as a word of conclusion, Mark, given that there is this anticipation of a longer term inflation and potentially a recession mechanism to come, how should you prepare as a bank?
Well, look, I think, I've never been a banker, but if I was a banker, maybe I'm biased here, but I think it's the right answer. You start by putting yourself in your client's shoes and thinking about how do you help your clients get through what I think is going to be an extraordinarily different economic regime from what most of us have experienced in our professional lifetimes. And so how are you helping your clients navigate their access to capital markets, and importantly, their cost of capital? How are you helping your clients, as we just talked about, think about how to finance the transition of their businesses in a high inflation period and potentially lower growth period through, at the same time, in some cases, an extremely costly carbon transition. And so I think for banks, they have to realize that now is the time where their advice, expertise, and products are most valuable to their clients. Clients are worried. Business leaders are worried. They're worried about the cost of inputs to their business. They're worried just about getting access to inputs at any cost. If I can't get stainless steel, it doesn't matter what price is. If I can't get enough to produce product, even if I can pass that through to my buyers, it doesn't matter. Access to labor, an increasingly complex regulatory environment, be it sanctions, and we've seen the positive sort of effect of economic sanctions in terms of putting pressure on Russia in the current crisis in Ukraine. Are we going to see more of that used as sort of a geopolitical tool? How do I navigate that as a business leader? All of this complexity, more regulation around climate and ESG. As a business leader and a business owner, how do I navigate that? I need help. I need help from BCG, by the way, but I also need a lot of help from my banking relationships. And I think that banks can be very successful here if they are preparing themselves to provide that type of assistance, put themselves in their client's shoes and say, wait a second, we can help you navigate these incredibly turbulent waters. And so I see it, I'm generally a glass half full guy. And so I think if I was sitting in a bank today, almost anywhere in the world, I would see this as a rising rate environment, a need for clients. My products are becoming less commoditized. The type of advice I provide is less commoditized. The type and structure of the capital I provide is going to become more specialized. And if I can do all of that, it's a pretty good time to be a banker, because suddenly I'm needed by my clients. And everybody's talked about the commoditization of corporate banking services. I think they're going to become less commoditized in the current environment. And the business leaders that I'm talking to, that you're talking to, they're all worried about sort of the broader macroeconomic regime that we're quickly moving into.
Mark, thank you so much for the fascinating discussion and the insight. I really enjoy it, in particular the glass half full perspective that you provided. Everyone, thank you for listening. Stay tuned, more to come.